Hello, everyone, and good afternoon to today's online class. Last week, we looked at tourism feasibility reports. That is how we can document the outcome of our feasibility study. And during last class, we were able to look at some elements that are supposed to be present when we are writing a feasibility report. Today, I would like us to have a recap of that last week episode. So I'll share my screen now so that we can have a recap of last week's episode. A recap of last week's episode of this online class. We treated feasibility reports when it has to do with tourism business. Please hold on. Let me get the slide so that we look at it once again before we proceed to what we have today. Please, I'm coming, hold on. Tourism business feasibility reports. Let us look at the elements once again, that is the components that are supposed to present in our tourism business feasibility report. All right, I'm coming, please. Let me share the screen. That is. I'm sharing the screen now. All right. I hope we can all see it clearly. Can we see it clearly? Please, I need a response. Can we see it clearly? Okay. As I mentioned, we treated tourism feasibility report last week. And I said, whenever you are conducting a feasibility study, you must bear it in your mind that you're going to write a report at the end of that exercise. And that report will showcase how feasible and how viable the tourism project is going to be at the end of the day. And during that class last week, we said at the end of the topic, at the end of our discussion, you should be able to understand what tourism business feasibility report is all about, and also be able to write what a good feasibility report for the success of a particular tourism business venture. Now, by way of a definition, a tourism investment feasibility report is a document that shows whether a tourism business plan will succeed or fail. And if the report indicates that the business cannot succeed, then you must think of another business plan. It's either you approach what you are writing using a different dimension, or you think of another business. As we said earlier during our introduction, that is in our week 1 of this online class, that tourism business or tourism globally depends on innovators and their innovations. If there is no innovation, we cannot think of new business. We cannot think of expanding an existing business. So therefore, tourism business is a kind of business that requires individuals to continue thinking. It requires thinking every day. You think of, what am I going to do in order to make sure that this business continues? What type of business can I establish in order to support tourism sector and also make an ends meet from it? So it's very, very important. And when you're now conducting a study, because of that innovation, either to establish a new business, tourism business, or to repackage an existing one, it is important to conduct a feasibility study and also write the reports at the end of that study. And it is that study that will determine whether the business is going to fail or is going to succeed. If the business is going to succeed, we will know. And if it's going to fail, the report should be able to show we're here before the network switched off. Now, I said for every new business or repackaging or expansion of an existing business, there must be a feasibility study. And at the end of that exercise, a report will show whether that business that we want to establish or want to repackage or want to expand is going to succeed or not. After that, we also we look at some elements of a feasibility report. And the elements comprises the elements in a feasibility report are the products, the market for the products, the management team, the production process and the production plan, the marketing plan, manpower requirements, estimated capital expenditure, estimated working capital, projected income statement, projected balance sheet, probability analysis, evaluation of the project. All these components are supposed to be present when we are writing a feasibility report. And we treated all of them one after the other that last week. And I'm going to going through them once again before we proceed to today's topic that I want to look at. Now, the products. This components called the products in a feasibility report is the section that will give where you are going to describe the product. You give a viewed, detailed description of the nature of that product. What is the product for? What is it going to, what type of, let me say, what type of satisfaction or what type of benefit will the consumer derive from that product? Under this section, one can also have the mission and vision or objectives of that particular product, of establishing that product, or of creating that product, of offering that product. This is the section where it's going to be tabled. Then after that is the market for the product. The market for the product is where we calculate market share. You must market share in the sense that now in an environment now, we know that this product I want to offer, somebody else is already offering it. Another person is offering it, maybe the same area, or globally, or regionally, or continentally, or nationally, or state-wise. Now, how many of us are offering, how many people are already offering that product, plus me or you? Now, all the people that are offering this product, including the people that want to venture into that product, to be offering that product again to the consumers, as all of them have become what? Competitors. And when we are now looking at the market for the product, we look at the competitors holistically. Those that are already offering the product and the new person that want to venture into that sector. They must know the number of competitors and also possible number of visitors or consumers that will consume that product. It's important that we know them. For example, let us assume there will be 50,000 visitors in a particular area where we want to be selling that product. And let us assume that at least 2 of them will spend nothing less than 200 naira a year. And now, let us assume again that all the competitors, including the new person that wants to venture into that particular sector, there are 5, just an example. That means we have example of 50,000 visitors. We have 200 naira as the minimum amount that a visitor might spend in that particular area on that particular product, purchasing that particular product. And let us assume that competitors are now 5. And here now we have I want to show us again the calculation. It has a formula, and the formula is market for the product will be annual expenditure times number of visitors. We say a customer is expected to spend 200 naira, and total number of visitors, according to our illustration, 50,000. So all we need to do is to multiply number of visitors by annual expenditure per person, and that will give us total market for the product. That is 10 million naira. So to now know our market share per each competitor, by each of the competitors, we will have that 10 million naira. We are dividing it by what number of the competitors, as we have said in our illustration. In that illustration, we say we have 5 competitors. And now the total market for the product is 10 million naira. So if we divide 10 million naira by 5, the line went off again. I don't really understand what is actually happening today. Well, let us continue from where it went off. So I was explaining the market for the product and how we can calculate market share per competitors, per each of the competitors. And we said the formula is annual expenditure by number of visitors. That is 200 naira by 50,000. And that will give us 10 million naira. And market share per competitor, 10 million naira by 5 will give us 2 million naira. That means each of the competitors is expected to make at least 2 million naira every year selling that product. Then the next we continue. The line went off again. So I talk of the management team. The management team under these elements, these components, we are going to describe, or we are going to, to state number of personnel that will be in the team. That is, number of people that will be involved in running the business, from the manager to other people. It can consist of the manager, maybe supervisors, sectional heads, clerical staff. It depends on the nature of the business. If it's a hotel, definitely, we're going to have board of directors, we're going to have managing director, we're going to have departmental heads, we're going to have sectional, that departmental heads, yeah, the sectional heads, the supervisors, before you go to other levels. That is, we have top, middle, and lower level management team members. So this section, that's where we are going to describe the number of people that will form the team. And also, we are going to state what will be their qualification, their background, the type of experience, maybe number of years, depends on how we look at the experience. Maybe we want to state the number of years they must have gotten in working in the industry before coming to join this new team. Then we talk about their benefits. What will be their benefits? What will be their wages or salaries or allowances, commissions, bonus, leave allowances, welfare, and other things. We're going to so on. Then after that is the marketing plan. It's going to involve marketing plan. Marketing plan. Marketing plan. Marketing plan. Yes. So it will involve marketing strategy that we intend to follow in order to achieve our sales target. Very, very important. Then also, we'll know that failure to meet our sales forecast will affect our what? Net profit. And profits, and this will threaten the ability of the business also to remain what? Profitable. So we need to state all these strategies that we are going to employ in order to achieve our what? Sales forecast. Then we also, there, we need to state our what? Marketing goals, and how you are going to achieve them under the marketing plan. Very, very important. Then after that, we'll be looking at, or we look at manpower requirements. This will estimate the manpower requirements, and also will outline the kind and number of personnel the business will need and their pay, just like we have in our management team. Then another very important section in our feasibility report is the estimated capital expenditure. As we all know, capital refers to those items that tie up capital for a long time and of course do not run over into cash fast enough or take several years to return their cash outlay. That is money spent on them. Then capital expenditure refers to what? Expenditure on plants and machinery, tools, transportation, equipment, superstructure, and so on. Then, because of the nature of business, can also include coaches, rangers, buses, and so on and so forth. Then, it can also include recreational items, furniture and fittings, and what have you. After that is after estimated capital expenditure is our, before I move out of that slide, it also, that under estimated capital expenditure, it will also include the cost of fixed assets, that is how much we are buying those capital assets, fixed assets. Then our startup cost, that is initial expenditure in starting the business before actual operation commences. All these will be shown under estimated capital expenditure. Then after that, we must also have what? Estimated working capital. Estimated working capital, that is estimated amount of cash necessary to cover during the period. We are going to also state this under our estimated working capital. Then anticipated expenditure before revenue begins. Then it will also contain expected payment for labor, utilities, rent, supplies, and other expenses. Inventory is another section that must surface under estimated working capital. Inventory covering initial raw material cost. And also, when we know all these, it will not be difficult to arrive at our working capital, that is estimated working capital. When we are working on feasibility report or feasibility study, anything we are doing is just like we are forecasting, we are estimating. So anything we do, we just say estimated this, estimated that. So under estimated working capital, all those items I've mentioned must appear. Then cash budget. When we talk of cash budget, it is in a way planning for our working capital. The cash budget is an estimate of our cash receipts and cash payments over a given period. And the cash receipts and cash payments are referred to as what? Cash flow. And the cash flow has two aspects: the cash inflow, the cash receipts, and the cash outflow. So the payment, that is the cash outflow. For instance, let us say we have estimated total cash receipts less what? Estimated total cash payment will give us cash balance. And we can prepare our cash budgets for a month, covering maybe a quarter, 6 months, or 1 year. But it's better we don't allow it to exceed 1 year. Then after our cash budget, we'll have projected income statement. Projected income statement is a summary of estimated operating expenses and operating revenue. So projected income statement will show what? Net profit or net loss. It depends. When we have our balance sheet from our trading profit and loss accounts, what we are supposed to have is net profit or trading accounts. We are going to have gross profit or gross loss. By the time we go to profit and loss accounts, we now arrive at net profit or net loss. So it depends. If the business we do very well, if the business is going to be successful, then we have net profit. But if not, it's going to be net loss. If it is net loss, it means the business will fail. We are not going to make profit if we invest our money into that business. So we need to rerun our cash balance, and that is adjusting our cash inflow and cash outflow. There are things you might cut down, maybe things we need to adjust or amend or modify so that our business plan, when we are writing it, will be bankable, because no financial institution will accept a business plan that is having a financial statement with negative variance. No. So we have to make sure that we do everything possible to arrive at what? Net profit. Perhaps we need to adjust some items so that at the end of the day, we'll be able to have a good business plan. Because the essence of conducting a feasibility study and writing a feasibility report is to write what? A business plan, bankable business plan. Feasibility study and feasibility report will give us a guide when we are writing a business plan. Then projected balance sheet, that's another section that must appear under Tozin Business Feasibility Report. The balance sheet summarizes what? The assets and liabilities of a business. And what are those sections in a balance sheet? We have asset section and liability column. Under liability column, we have capital and current liabilities. Then under assets, we have fixed assets and current assets. After projected balance sheet is our please hold on. Okay, still under balance sheet, we will have our cash on hand, cash at bank, inventory, maybe work in progress, all those things that are cash that we can calculate. They are called what? At the end of the day, they are under current what? Liabilities. For instance, if we want to know our cash balance from our balance sheet, is to deduct the liability side, to deduct the asset side from the liabilities side. That is fixed assets plus current assets. We'll now deduct it from our capital and current liabilities. So the outcome supposed to be what? 100,000, supposed to be what? Cash balance. For instance, if our asset side, except cash, for instance, is 9 million naira, then the sum of liabilities will be what? And let's say the sum of liabilities is 10 million naira. Therefore, 10 million naira minus 9 million naira will give us what? 100,000 naira. I come again. If we deduct our assets from liabilities, we are going to have cash balance. And for example, let us say the sum of our asset side is 9 million naira and the sum of liability side is 10 million naira. If we deduct assets from liabilities, the outcome will be cash balance. Therefore, 10 million naira minus 9 million naira will give us 100,000 naira. And now we take our class activity. And this says a tourism feasibility report contains certain elements. Mention 4 of those elements. Those are the ones we've mentioned for, starting from the products, the market plan, production plan and production process, management team, projected income statements, estimated working capital, and the rest of them. So those are the elements that must appear. But one thing we should know is that even if all those elements cannot appear, you cannot really work on those ones, then you should be able to at least get your market forecast right. That is sales forecast, market plan, cash flow budget, and as well as projected income statement. Very, very important. And that was where we rounded up the class last week. So today now, permit me now to now run what we have for today. That is tourism projects funding, tourism business project funding, tourism business project funding. That's what we want to look at today. Let me share with us. It is coming up. I talk of tourism project funding. I want you to understand that after we have made a good decision on the type of tourism project we want to invest in, source of funds is another cogent, let me say cogent junction or cogent stage in writing our business plan, or very, very significant to running a tourism business. We must know all those expenditures, cash budget, cash inflow, cash outflow, working capital, all those things that we have mentioned in our feasibility report. We've we've estimated the costs or the prices or even the sales. But now, how do we source for funds? Because when we say cash inflow, how do we get the cash? Cash outflow, we know that that means expenditure, but cash inflow, very, very important. How do we get the cash? How do we get the funds? How do we actually secure the necessary funds that we need to run the project? And it is otherwise referred to as what? Finance decision. So therefore, today, we are going to consider sources of tourism project funds. Now, at the end of the topic, you are supposed to discover sources of funds in tourism business organizations. How and where can tourism business investors source for funds? That is what we want to look at. So by the time we finish this discussion, you should be able to know how and where we tourism professionals can seek for funds when we want to establish or want to expand our business. Those activities that bring in cash are called sources of cash, as I've mentioned earlier. Then those activities that involve spending cash are called what? Uses or application of cash. Then some of the major sources of this project funding include what? Personal savings, borrowing from family and friends, borrowing from financial institutions, internal funding, venture capital, sale of securities to the public, leasing, long-term debt issuance, and grants. These are the sources of tourism project funding. Now we take them one by one, but before we proceed, let us look at this last activity. What do you understand by sources of funds? Can somebody help us to answer that question? What do you understand by sources of funds? You can unmute yourself. What do you understand by sources of funds? Okay, good. Now, can you please mention 5 sources of funds for a tourism project? Mention 5 sources of funds for a tourism project. Mention 5 sources of funds for a tourism project. 5 sources. We've mentioned them in the slide preceding this one. Say personal savings, borrowing from family and friends, borrowing from financial institutions, internal funding, venture capital, sale of securities to the public, leasing, long-term debt issuance, and what? Grants. But I would like to take them one after the other. We still have more time. 1, personal savings. We have to close by 4. So we have some like 18 minutes. Let's see what we can do today. If we cannot finish it, then by next week or in our discussion forum, we can do justice to the rest of them. Personal savings. Finance for a tourism business, depending on the size, that we sourced through what? Personal savings. When we say personal savings, that is the money you are able to save by yourself, maybe from your present employment or salary, maybe from your any income that you are having, maybe from money people are dashing you, or you do one business and you make some profit and gain and you are saving. Having it in mind that you are going to start a particular business very soon. So as we are saving, we can call that a source of what? Funds for tourism projects. Then, however, as we know, if the project is big, personal saving might take a long time before we can save enough to actually commence the business. So personal saving, in my own view, is applicable to small businesses. You understand? Because when you are saving, maybe someone that wants to go into, although it depends on the type of revenue you are making at present. You understand? But generally, for somebody not to now save that want to establish an airline, how long will the person save even to buy an aircraft? So even to build like a five-star hotel, even a guest house of like 20 rooms, or a motel, or even let's say hostel, you know, it's going to take those ones I mentioned are they are capital oriented. So personal savings is good for small businesses, but not for big businesses. If you want to save using personal source for a big business, it's going to take a very long time. So therefore, I think personal saving is good, but not for big businesses. Then another one is borrowing from family and friends. Yes, a tourism business investor can also approach friends and family members in order to raise what funds for the project. And this source can attract what little or no interest depending on the relationship. Yes, one can borrow from families, members, you can borrow from friends. It depends on how close or how how deep or how viable they look into your, or how profitable, or they look into your proposal. That is, if you tell them I want to use this money for this type of business, if they think that yes, I think I have interest, I think that business will succeed, I think that business will fly, I think that, then if they have money, they can borrow. But to borrow money from family and friends, I mean, you have to visit maybe at times a lot of people in order to get money, and you're going to borrow from them. And for them to lend you that money, some might say, no, I'm a business person too. If I lend you this money, then it must be returned with an interest. So if that is the case, you have to now sit down and now know the terms and conditions for that particular money you are borrowing from that fellow, that friend of yours or family member of yours. So, and some might say, no, don't worry. Uh, I just give you like 1 year or 2 years or 6 months or 1 month to return the money to me. So it all depends. Then after borrowing from family and friends, another source that we mentioned is borrowing from financial institutions. When we are sourcing for funds, we can borrow from financial institutions. And when we talk of financial institutions, we know that these include banks, it could be commercial banks, or the developmental banks. And when you're approaching any financial institution for funds, of course, the first thing they will ask for is your proposal, business proposal, especially for new businesses. When you want to establish a new business, they will definitely ask for a proposal. They want to see how bankable or how profitable that business will be. If they study your business proposal and they realize that, oh God, oh my God, this business is really going to sell. The profit margin is so high, and in fact, it's going to make it. They can go ahead and borrow you the money, but you have to go through some processes, from studying your proposal to asking for collateral to looking for guarantors to let me say, if you have collateral, they might want to evaluate it. That is valuation. Then apart from that, there are documents you have to sign, and it's not going to be that you get there today and you get the money today. No, it will take some time. But there are people that are still getting money. They are borrowing money from financial institutions. And even if you have borrowed once and they feel and you're able to repay as at when due. When you approach them next time, they will easily do that. But if when you borrow money from them and they start running after you, calling you, running after you before you pay back the money, when you go back, they might say, huh, they might not be willing. They will not be willing to really borrow you money again. So the best bet that when we borrow money, it's important that we repay. And also it will attract terms and conditions such as amount, interest rate, duration, mode of repaying principal and interest, and other ones. And apart from borrowing from financial institutions, internal funding, that is, if you are having an existing business, you might be uh, sourcing for uh, tourism project that you want to establish or want to expand using internal funds. And this is looking at your what retained earnings. When you are preparing uh, your financial statement, there is a place you have to at least set some amount aside tax what retained earnings. Not every profit that you make that you will just uh use everything. No, you have to set some amount aside called retained earnings. So when we want to establish a new business or want to expand an existing one, that is for someone that's already in a business, then you can now look inward into your what retained earnings from the previous profits after paying dividends. After paying dividend, take notes. That means that if the business is like maybe uh let me say private limited liability company in short, they will pay dividends on shares that shareholders bought from them. Then after internal funding, we have venture capital. When we talk of venture capital, is a financing source of startups, usually with high risks that are not attractive to financial institutions. As I mentioned, when we're treating borrowing from financial institutions, when you submit your proposal to all these financial institutions and they feel that, well, the risk is high, the profit is low. If we borrow this person, if we lend this person money, how is it going to pay back? Are we not going to be in trouble? Are we not going to be in a mess? No, they might turn down that proposal. They might turn down that request of yours. So it's now another option for you might be to look into venture capital. Venture capital list, they have their money, private money, and one can source money from them. And these are the people just like pensioners, maybe the pension funds, individuals, large corporations, insurance companies, and so on. They are in this category of venture what capitalists. And the type of fund that we search from this group of people or group of companies is called what? Venture capital. But one thing is that when they are lending you money, they are seeking for what? Compensation. And they might want to have a very high share proportion of the profit. Let's say if the profit is now 100%, they might be demanding for like 60%. And a particular number of seats on board of directors, that is for liability, limited liability company. They want to be among those in the board of directors, and they might require, let's say, if board of director members are like 20, they might say no, they want to have like 12 or 10. They'll give you terms and conditions. So if what they are requesting for is okay by you, then you can go ahead and get the money from them to start the business. Then another one is sale of securities to the public. That is initial placement, selling shares to the public. It could be preference shares, ordinary shares, and what have you. But shareholders are supposed to vote during the annual general meeting. When you have sold shares to the public, then you must hold annual general meeting on yearly basis. This is where they will vote. This is where they will discuss issues affecting the business and their shares and and the company as well. So this is selling of shares to the public in order to raise funds. Depends on the type of share you want to sell. And when you are selling shares to the public, know that that process must be registered with the Securities and Exchange Commission. Very, very important. And this sales can be through public or private placement, especially if the capital expected to raise is not very huge. Then apart from sale of security or sale of shares is leasing. In fact, this leasing, if you really understand it, it will relieve one of spending huge amounts of money on a fixed assets such as superstructure, equipment, superstructure and equipment especially, because when you talk of leasing, a lease is a contract that transfers the right to use and control an asset from its bona fide owner to user who pays periodic rental payments. So instead of buying like a house of 10 million naira, you can go and lease a particular building that you think will suit the business and is the location is very good for the projected business. Then you can go for that. So instead of spending 10 million naira on the building, if you say you are leasing it for maybe 10 years or 20 years, depending on how long you think you run the business, you might just be paying like 500,000 per year. Don't you think that is better than spending only 10 million naira on a building? So you can go on leasing. Then who is a lessor? A lessor is the real owner, that is the owner of the property that you want to lease. And a lessee is you that you want to lease the property or the equipment. So the leasing premium is the periodic payment. So the money you pay is called leasing what? Premium. And it's a periodic payment to be made. And the lessee, that is you will use the asset because of the little payment or the premium, excuse me, instead of spending huge amounts. And the time is running against us. And the next one supposed to be long-term debt issuance. And long-term, there are of two types. We have bonds and direct private and long-term loans. Then another one, apart from long-term debt issuance, is grants. Yes, grant is like a free money, but you have to seek for it. When you get it, you might require to fill a form. They might ask for your business proposal, and it's usually can be offered by individual, government, NGO, either to start up owners or existing tourism business owner without paying back. You don't pay back the money, unlike other sources. You pay back the money, and you, apart from you don't pay back the money, it will attract no interest as well. So it's just for you to make use of the money very, very well. Make judicious use of it very, very well. So before we conclude, let us look at this activity. Explain 5 sources of funds that you know for a tourism project as listed in activity 1. When you do that, then today we have looked at sources of funds, and they include personal savings, borrowing from family and friends, borrowing from financial institutions, internal funding, venture capital, leasing, long-term debt issuance and grants, and also venture capital. So on that note, we round up today's class, and I hope to see you again next week, same time. So from my end here, I say have a very good weekend, and please visit the course page. There are announcements there. There are things we need to do there. Please make contribution, check your course materials, look through them, study them. Then next week, we look at another topic. So please kindly go through all the class activities in all the instructional videos. Try and watch them. You have the links When you visit the course page, you will see the links there. So I wish us a very good, happy weekend. Bye-bye.